Hello and welcome to Quarterly Perspectives, third quarter 2019. My name is Justin Rice and I serve as one of the financial advisors at Personal Wealth Strategies, and I'll be your host for this presentation. The presentation is divided into two parts. The first part reviews recent asset returns, and the second part looks at recent market and economic headlines. We start our return discussion with a high-level look at a collection of major asset classes. As we can see from the illustration, U.S. stocks and bonds were higher during the quarter, but non-U.S. stocks declined, especially those in the emerging markets. Let's look a little deeper at what was driving the returns of stocks and bonds. We start by looking at how developed stock markets performed over the past 12 months. We can see a wide range of results which speaks to the need to diversify. While it would have been great to have all our money invested in Switzerland, the best performing country, investing in only one country introduces the possibility that all of our money could have been in Austria, the worst performing country. The dots on or near each country's bar represent how the local stock market performed over the past 12 months. In most cases, stock market returns measured in the local market currency were better than when converted to the US dollar. This is because the US dollar appreciated in value versus most currencies over this time period. A similar trend with an even wider range of returns occurred in the stock markets of emerging countries. Brazil had the best return, and Pakistan had the largest decline over this 12-month period. Our evidence-based investment process has us favor several factors of return. One of those factors is a preference for small capitalization companies versus large capitalization companies. History has shown that small companies tend to outperform large companies over the long term. Looking back over the past 5 years, we see that outperformance in international developed companies, but we didn't see it in U.S. and emerging market companies. Another factor we put emphasis on is value companies. Historically, value companies have outperformed growth companies over the long term. Yet, over the past 5 years, we can see that large growth companies outperformed large value companies. When we look at small capitalization value companies, we see that emerging markets small value companies have done well versus growth companies. We also see that U.S. small value and international small value companies had periods when value outperformed and periods where they didn't. While we expect our factors of return to always deliver positive results, realized returns are often different. This is why we diversify into multiple factors of return. Turning our attention to bonds, we start by looking at recent interest rates. Here we plot what is commonly referred to as a yield curve to show us how much interest we receive from bond investments with different maturities. The green line represents interest rates at the end of 2018, and the blue line represents interest rates at the end of the third quarter. Since the blue line is lower than the green line, we can see that interest rates decrease during the year. Bond prices rise when interest rates fall, and this helped boost bond results for the year-to-date period. We typically prefer investing in bonds that have shorter maturities and higher quality than the broad bond market. During the third quarter and for the year, falling interest rates helped all bonds, especially longer maturity bonds as seen in the graph on the left. In the chart on the right, returns were fairly similar across all credit qualities for the quarter, with a slight edge towards the BBB rated bonds. On this slide, we look at the absolute impact of different asset classes on a sample 65% stock, 35% bond index mix. Large U.S. stocks, bonds, and real estate investment trusts all produced a positive impact, while non-U.S. stocks and U.S. small company stocks reduced return. Looking at year-to-date asset class returns, we see asset classes in your portfolio ranging from a positive 24.6% for real estate investment trusts on the high end to 1.8% for emerging market value and cash on the low end. Maintaining a diversified asset mix, such as the 65% stock, 35% bond mix shown in white, kept us away from the more extreme returns from year to year with significantly less volatility over the last 15 years. Highlighting the importance of maintaining a well-diversified mix of asset classes in our portfolios. Let's now turn our attention to some of the major stories we saw in the most recent quarter. New information comes out daily, potentially impacting the direction of individual companies and the overall market. While this collection of headlines isn't meant to explain why the global stock market returned what it returned, we present it to help illustrate that there is a lot of short-term news that may tempt us to make an investment decision we may regret. It is wise to stay informed, but we feel it very important to keep a long-term perspective when it comes to investing. As we can see from some of the quotes, investors had to digest a slowdown in multiple key economies and economic activity measures, central banks like the Fed and European Central Bank lowering interest rates, and market volatility. We mentioned before how our investment process favors several factors, which includes tilts towards small and value companies. Although in recent years, as can be seen in the left chart, small value companies underperformed other U.S. stock asset classes since January of 2018. However, the factors of return can show up quickly and suddenly, as seen in September of this year, when U.S. small value stocks surged. This speaks to the need to stay invested in these strategies to receive the potential benefit. U.S. growth companies have also had an uncharacteristically good run. In the past 10 years, as of June 30th, 2019, they've had an annualized return of 16.3%, compared with their average return since 1926 of 9.7%, shown on the right. Whereas value companies, shown on the left, have performed similarly to their long-term historical average. While some would be quick to say, "Give me more growth stocks," we feel the opposite may be a more reasonable response, since abnormal performance, up or down, turns into average performance over time. With the federal funds rate cut twice in the third quarter, it is currently in a range of 1.75% to 2%. The market does expect another quarter-point rate decrease before the end of the year, especially as the US dollar stays strong relative to other currencies and global trade pressures persist. Lower interest rates make it less expensive to borrow, which theoretically helps an economy expand faster. The U.S. was not alone with falling interest rates. A comparison of interest rates from major developed nations shows that interest rates have fallen a good deal this year. Interest rates at the beginning of the year are represented by the blue bars, and interest rates at the end of the third quarter are in green. Every green bar is lower than its corresponding blue bar. While we never know with exact certainty why interest rates change, it is easy to conclude a slowing global economy, stock market volatility, and central banks lowering interest rates among the reason for the decline. It is important to note that bonds increase in value when yields fall. However, lower yields mean we don't receive as much income from newly issued or purchased bonds. The final slide I'll conclude with is meant to help you maintain a long-term perspective. As investors, we want to capture the highest expected return per level of risk we are willing to take. Historically, over long periods of time, the best potential for accumulating wealth has been to include the stock market in your investments, especially small value companies. While we are concerned that lower interest rates means we earn less interest on our bonds, we take comfort in knowing that we use bonds for preservation and diversification. So, as long as you maintain a long-term time horizon and invest within your risk tolerance, you should not be overly concerned about short-term market volatility. These are the benefits associated with an evidence-based approach to investing. This concludes our presentation for today. Thank you again for joining me. Until next quarter, goodbye.